Welcome back to the Deep Dive. Today, we're jumping into a really interesting one, a foundational industrial player, Alliance Laundry Holdings, ticker ALH.
Yep, their Q3 2025 earnings call. And this is a big one because, this was their first report as a public company. They just had their IPO back in October.
And for anyone who doesn't know ALH, they're the number one pure play commercial laundry manufacturer in the world.
Exactly. Think laundromats, hotels, hospitals. They build the machines that are basically critical infrastructure. It's just disguised as, industrial hardware.
Right. So our mission today isn't just to read off the numbers. We want to get into the story management is telling and then stack that up against how the market actually reacted.
Because there's a huge paradox here.
A huge one. They delivered a massive beat on everything, and yet the stock just cratered. We need to figure out why. Why is Wall Street so skeptical of this company?
Precisely. It was like textbook execution meeting this wall of institutional skepticism.
Yeah.
So let's start with the headline numbers. They dropped pre-market November 13th.
And the financials were, objectively stellar. The bottom line was a huge beat. Non-GAAP adjusted EPS came in at 28 cents.
Right. And the consensus on Faxetet was 22 cents.
That's a 27% beat. That's remarkable. And the top line was just as strong. Net revenues hit $437.6 million.
Up 14% year over year. And that also sailed past the consensus of around $423 million.
So it wasn't just revenue growth, it was profitable growth.
Oh, absolutely. Adjusted EBITDA was up 16% to $110.8 million. And look at the margin, 25.3%. That's up 40 basis points from last year. So management is on the call saying, strong first quarter as a public company. And honestly, based on the numbers, they nailed it.
Okay, so here's the puzzle for investors then. If you beat EPS by that much, you're growing revenue by double digits in a sector like this. Why on earth would people sell into that news?
I know.
We saw the stock pop at the open and then just an aggressive fade all day. It closed down almost 5%. That tells me there's a fundamental lack of trust in these results.
It does. It signals that the market is still looking at ALH through the lens of its history. It's pre-IPO life, not just Q3. They're looking past the great quarter to the balance sheet and maybe more importantly, to the guidance.
So they're demanding proof, not just one good quarter.
Exactly. They need to see that this is a long-term, sustainable compounder, not just some, cyclical peak that was engineered for the IPO.
Let's dig into that top line then. That 14% growth is fantastic for a manufacturer. How much of that was them just hiking prices versus selling more machines?
That's the good news. It was definitely volume-driven. Management was pretty clear that roughly 2/3 of that growth was from actual solid volume gains.
Okay.
The other third was from, modest price increases, low to mid-single digits.
That's a healthy ratio. It shows there's real demand.
It is. And those price increases weren't just for fun. They were to offset higher input costs, especially tariffs. The fact they did that and expanded gross margin by 70 basis points year to date, that's just excellent discipline.
And was this all happening in the U.S. or was it global?
It was pretty broad-based. North America was up 14%, sure, but international also grew 12%. And it was balanced growth, too. In Europe, their Speed Queen license stores are getting a lot of momentum.
Right.
And then in developing markets, think APAC and Latin America, Thailand, Indonesia, the Philippines. They're really growing their footprint there successfully.
Okay, so let's get to it. The elephant in the room that's casting a shadow over all this good news, the balance sheet.
This is the central tension point.
ALH came to the public market with all this baggage from being a private equity asset. Why is that ghost of prior debt so toxic to investors?
Well, it's all about how these companies are managed before an IPO. PE firms often do these things called dividend recapitalizations.
Which is just loading the company up with debt to pay themselves, right?
But in a nutshell, yeah. They load the company with debt to pay a huge dividend to the owners, the PE firm, and then they take it public. So you get this highly profitable company, but it's carrying a mountain of debt.
So job number one, post-IPO, has to be fixing that balance sheet.
It's the absolute defining priority. And to their credit, they went right at it. Yeah. They used the $525 million from the IPO, plus another $135 million voluntary paydown in Q3 to just slash their debt.
And where did that leave them?
They got their IPO adjusted net leverage down to about 3.1 times.
3.1 times. That's a big drop. And for a post-PE company, that's a pretty respectable place to start, isn't it?
It is, and the immediate benefit is huge. They're looking at around $46 million in annualized interest savings.
46 million.
Think about that. That $46 million just immediately boosts the bottom line, boosts free cash flow. It's already getting them credit rating upgrades from S&P and Moody's.
But the market's still worried. Management sounds proud of hitting 3.1x, but if they've saved all this money, why is debt still the main story?
Because it's about the absolute number and the path forward. External commentary, from the big financial news outlets, they keep pointing to the history. The market seems to be saying 3.1 is good, but we need to see a clear and fast path to the mid-twos.
So that's the magic number, mid-2 times leverage.
That's typically where big institutional investors really get comfortable and stop seeing it as a highly leveraged PE asset. Management promised they'd delever by half a turn to a full turn per year, but investors want to see it happen now.
The pressure is definitely on.
Yeah.
Okay, let's shift to the bigger picture story, the innovation, the strategy, because that's what turns this from a debt story into a growth story.
Exactly. And management spent a lot of time on this. They kept talking about the structural appeal of commercial laundry. The CEO had this great line, "Thank God for laundry."
I like that.
It's essential. It's non-discretionary. It proved it was recession resistant even during COVID lockdowns. It's a very stable, replacement-driven business.
But stability alone doesn't get you a growth multiple. They need innovation on top of that. What do they actually show off?
They had a lot at the Clean Show 2025. Two things really stood out to me. One was the industry's biggest 55-pound stack tumbler. That's all about throughput for operators.
More clothes, faster.
Exactly. And the other was the scan pay wash system.
Oh, the Apple's cashless payment thing. That feels like a game changer for laundromats. No more quarters.
Totally. It just removes all that friction. And internationally, they showed something called the Stax X, a washer dryer developed in Thailand, which is a great example of their whole local for local strategy, designing products for specific markets.
They also made an acquisition, right? Metropolitan Laundry Machinery sales in New York. How does that fit in when they're so focused on paying down debt?
Well, the CFO was super clear on this. Capital allocation is disciplined, period. CapEx is capped at 3% of revenue. And while they have an M&A pipeline, the priority is still organic growth and debt reduction.
There's no big splashy acquisitions anytime soon.
Not if it jeopardizes the deleveraging plan. It's all about profitable growth, not just growth for its own sake.
Now, the real future-looking part of this story seems to be their digital platform, Insights. This feels like their path to, higher margins, recurring revenue, that whole SaaS model dream.
This is where you have to look past the old school industrial metrics. Management admitted that right now, today, the revenue from digital is minimal.
Right.
But that's not the point. The goal right now isn't SaaS revenue. It's about embedding value. They're connecting hundreds of thousands of machines to capture all this proprietary data.
And the data lets them do what? Predictive maintenance.
Predictive maintenance, real-time diagnostics, optimizing wash cycles, pricing. It lowers the total cost of ownership for the operator. And it's especially powerful for the new guys, the multi-site owners who need that system-level data to scale. If they pull this off, the whole valuation story could change in a few years.
Okay, so if the quarter was great, the debt plan is aggressive, and the future strategy is clear, we have to come back to it. Why did the stock get punished? It has to be the forward guidance.
It was the guidance. Management basically threw a bucket of cold water on expectations for Q4.
What did they guide to?
They said Q4 revenue growth is expected to moderate sharply, down to the mid-single digits.
Wow. Okay, that is a massive deceleration from the 14% they just posted. As an investor, I hear that and I immediately think, was Q3 the peak?
That's exactly what the market thought. Now, management tried to frame it. They said, this is just reverting to a more normalized growth rate after 2 years of double-digit growth, and Q4 comps are really tough. But the market didn't hear normalization. It just heard deceleration.
And that fear ties right back to the debt, doesn't it? If growth stalls, that promise of paying down a half to a full turn of debt per year gets a lot harder.
It gets so much harder. The whole narrative rests on strong, sustained free cash flow. Any hint of a growth slowdown makes the market nervous that they can't actually pull it off.
And there's one other red flag they mentioned on the call, right? Tariffs.
Yep, a big risk factor. ALH has been able to pass those costs on so far through price increases, but, and this is the key, they noted their competitors haven't fully raised prices yet.
Oh.
So if demand softens, they could get squeezed. That margin expansion we were just praising could come under some serious competitive pressure next year. It just adds another layer of skepticism.
All right. This is not financial advice. Let's be very clear. This is for educational and entertainment purposes only. Based on the earnings call material, we are not recommending you do anything. Please do your own research.
Mandated disclaimer, check.
Okay, that out of the way. Let's do the fun part. Given this whole conflict, great quarter, scary guidance, heavy debt, what's the outrageous but plausible trade idea here?
Okay, so my pitch focuses on the long-term story, the deleveraging, and basically says the market is being way too emotional about this Q4 slowdown.
All right, lay out the hedge fund pitch for us.
The thesis is simple. The market is completely mispricing the value of that $46 million in interest savings. That is a guaranteed massive boost to future cash flow, period. And ALH has a real moat 40% market share in North America. An essential business, it's recession-proof.
But analysts are treating it like a boring old industrial company.
Exactly. They are missing the embedded SaaS-like value of the digital platform. They're just looking at the machine sales.
So how do you play that? How do you capitalize on the market's short-term fear?
The trade. A short-term bear, medium-term bull strategy. You buy long-dated call options, 18 months out, maybe more, to capture the full deleveraging cycle. At the same time, you sell near-term downside puts.
So you're betting the stock drops a bit more on the Q4 fears.
Exactly. You're betting it will drop, giving you a better entry point for the long-term story. But you're also betting that they will execute on that debt reduction, that 0.5 to 1 turn per year. You're betting on the cash flow, not the headline growth number.
And the payoff comes when?
The payoff comes when they hit that mid-2x leverage profile. That's the moment they shed the PE ghost label, and suddenly all these huge institutional funds that couldn't touch it before can now buy in. And your ultimate hedge is what the CEO said. At the end of the day, people still need laundry.
That's a fantastic thesis. It really captures the whole conflict here. Alliance Laundry delivered this really strong quarter. They're being aggressive on debt, but the market just can't see past the Q4 slowdown and that big pile of PE debt.
Right. And the path forward is clear, but it's really, really challenging. So the provocative thought I'd leave you with is this. Can management actually maintain that balancing act?
Can they keep investing in the digital stuff and the M&A they need for future growth while also hitting those super disciplined debt targets the market demands?
That's the whole question, making that transition from a PE asset to a public compounder.
And that transition is what's going to define this stock for the next couple of years. We'll get our next big update on the Q4 call. Until then, remember to do your own research.
We'll catch you on the next deep dive.